All right. Today is Thursday, December 15th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. What a day it was. We got the delayed reaction from the FOMC today, and perhaps more to come. And therefore, I was mad at the weak bears, shall we say, who during the FOMC were panicking, oh, why is the stock market not down big? I think it's going to go up. I'm going to cover my puts. You got it wrong, Maverick. And on a day like this, you probably regret your hesitancy and lack of decisiveness. You see, today is one of those days in the stock market where a lot of gains are made. We don't get these kind of days all the time. They happen few times a year. Sometimes you have to wait for years to get days like this, and they happen on the upside and the downside. So the moral of the story of today's trading action is, number one, a lot of us are investors, and investing in the stock market requires very little risk. All what you have to do is not be a moron and invest in good companies with good valuations and have a long-term horizon, and 9 times out of 10, you'll walk away with profits. The other thing that we do, most of you at least, is trading. And trading the stock market requires a little more risk-taking because it is the business of speculation, which is, by the way, at least 90% of the wealth created in this country is created via speculation. Now, the difference between speculation and gambling is, in the case of speculation, before making a bet, you're assessing the data, you're gathering the facts, you're doing the analysis, and then you make an educated bet based on the outcome of this analysis, and hence you're speculating. Gambling, on the other hand, is placing a bet without knowing what the outcome is going to be, because you have no set of facts or data or analysis that can help you to know what the next card is going to be. So if you watched last night's video, I explained to you using the data, the facts, the analysis, that the chairman of the Fed, Jerome Powell, made it clear that the market needs to go lower. So it doesn't matter what the stock market is going to do in that specific day. We've heard enough. We got enough data points, enough facts, enough analysis to lead us to the conclusion that the market is going down. And therefore, those with brass balls, those who did not hesitate, those who speculated and made their bets boldly and with confidence and conviction got rewarded today. And we're talking about massive gains, in certain cases exceeding 1,000% in a single day. Now, rest assured, if you missed this one, we're going to get plenty more days like this until the bear market is over. But they're not going to happen every single day. So once again, the moral of the story is, in trading the stock market, you got to be bold, you got to have conviction and confidence because you did the homework. And sometimes you're going to end up being wrong. And that's part of the game. But if you do the analysis, you play the devil's advocate, you do your homework, in the long run, the majority of your bets will land and some will not. And all in all, your portfolio will be profitable. We're in the risk business, ladies and gentlemen, because the reward is worth it. If you don't want to take such risk, you might want to take, a regular office job, maybe cutting somebody's lawn. That doesn't require a lot of risk taking, so long as you watch your foot. But we choose to be in the risk business because we seek the highest reward. And that's that. Now, today was significant, not just from a market perspective, but from a macroeconomics perspective, because the fantasy of the soft landing died today. So let's walk you through the events from the start of the day. Before the market even opened, overseas, across the Atlantic, we got more news, more central banks tightening and following the Fed's footstep. For example, the SNB, the Swiss National Bank, increased rates by 50 basis points, and they revised their outlook for inflation to stay higher for longer, meaning perhaps the SNB will continue to raise rates for longer than expectations. And to combat inflation, perhaps the SNB will seek to keep rates higher for longer, as the Fed indicated yesterday. And this will cause a massive slowdown in economic activity, which will lead to a recession. For example, the SNB now sees the 1,000 franc banknote circulation drops because they're raising rates and they're seeing the demand for these large notes dropping. In other words, the pace of economic activity is slowing down in a major way. And on top of that, we got news from Norway right after that, also raising rates to 2.75%. This happens to be the highest level in more than a decade by the Norwegian Central Bank. So we're setting a theme here. The Fed raises by 50, SNB, the Norwegian Bank, and they're all revising their core inflation rate higher. They're all revising their interest rate hikes higher. And then we got the news from the BOE, the Bank of England, and the ECB, the European Central Bank. Both of them also raised rates to the highest level since 2009 by 50 basis points each. But most notable is the speech by Madame Lagarde, which I thought it was extremely hawkish, to my surprise, of course. But she basically indicated that the fight against inflation is not over, and they're going to have to raise rates way higher than market expectations, and inflation will stick for longer than expected before. And of course, this is all happening because the cabal of central banks has been playing the transitory tune, dismissing the rise in inflation, and now they're playing catch up. And now they're realizing that they have ways to go before tackling inflation down. And in tackling inflation down, it's not going to happen without inducing a recession in the economy. So right away, the decisions from central banks across the Atlantic and the extremely hawkish speech by Madame Lagarde impacted futures negatively here in the United States. And we saw the market sliding down big time, and the pain continued throughout the session all the way till the end of the day. No mercy at all. But most importantly, right after the open here in the United States, we got a slew of macroeconomics data that solidified the case that the recession is in the bag and the soft landing is just a mere fantasy which will never, ever, ever, ever happen. And of course, you have all of these perma-pumpers who, by the way, playing a role. They're not real analysts or strategists or anything. The likes of Tom Lee, for example, who says the stock market will jump 18% in 2023 as this year crisis becomes next year's opportunities and the economy heads for a soft landing. Now, these clowns are losing credibility by the day. They've already lost an immense amount of credibility, and now we know that this soft landing fantasy will never happen. And therefore, we got a massive readjustment in the market today, and there's more readjustments to come. Take, for example, if you remember, the former vice chair of the Fed, insider trader Richard Clarida, who came out today and said if financial conditions ease because the market is up or the market continues to price interest rate cuts in 2023, the peak policy rate of 5.25% might not be sufficient to put inflation down in the path to 2%. In other words, what the insider trader is saying, if you guys rally the stock market higher because you think the Fed is bluffing and it's going to cut rates in 2023, all what you're doing is loosening financial conditions and pushing the Fed to raise rates even higher, which will crush the stock market even more and crush the economy even more. In other words, let the Fed do their job. Consumers, the perma-pumpers, the blind bulls in the market, step aside and stop making the Fed's job difficult, more difficult than it already is. Otherwise, we will see more damage in the market and more damage in the economy. Now, with this intro out of the way, let's move on to the main topic of this program. And here it is, in focus tonight. Rest in peace to the soft landing fantasy. It's over. Today we got the confirmation there is no soft landing. Now let's start with this. And again, folks, I'm teaching macroeconomics the hood way, the street way, because I know a lot of you have jobs, you don't have the time to crack the books. So I'm teaching you the common man and woman way. So this is meant for illustrations only, not to be particularly scientific, although you're going to get the point. Let's assume that this is the status quo. We got the 0% line, of course. Any reading below this line is contraction. Any reading above this is growth. And then we have 2%. This is where the Fed is targeting inflation to be. And then we have the red column. This is inflation. Now it stands at around 7%. Now, mind you, this is the cooked number, but we're going to roll with it anyways. Now, the green column is a combination of economic activities. And I'm estimating that the economic activities are positive by about 2%. You can factor in the GDP, for example. You can factor in the hot jobs market, for example. But you can also factor in within that the absolutely horrific macroeconomic news that we got today. Now we start with the good. And the good comes from the job market. No surprise here. In the morning, we found out that jobless claims went down to 11-week low to 211,000 claims. Now we all know that unemployment hits the economy with a lag. Because employers don't lay employees right away, they have to wait for demand to be crushed and to be 100% certain that they have excess employees they don't need anymore, and then the layoffs come. But besides that, let's take the number at face value that it is good news for the economy. But we got a lot of bad news today. Among them, retail sales went down in November despite Black Friday. And the reason is the consumer is facing inflation. They have no more disposable income to splurge in the economy like they used to. We also got U.S. factory production, which went down for the first time since June. And according to Liz Young, if you see the trend right here, the recession typically associated with a meaningful drop in utilization rate, and we're just getting started here. In other words, if the utilization rate continues to drop, soon enough this will be an indicator that the economy is indeed heading into a recession. And it's not really the best leading indicator because it comes right before the recession hits, but something worthy to keep in mind. On top of that, we got bad news from both the Empire State and Philly Fed manufacturing indices. The Empire State Index is in contraction territory. So is the Philly Fed manufacturing index. It is reading negative for now. So you combine all of these pieces of data from the jobs market, from the PMIs, from the manufacturing indices, from the utilization rate, etc., and we come to a rough estimate of about 2% when it comes to the pace of economic activities. But mind you, in the status quo, we have a major gap between inflation, which stands at around 7%, and let's say whatever indicator for economic activity you want to use, be it the GDP, be it the jobs market, be it the PMIs, it doesn't matter. There is a massive gap in which inflation surpasses the pace of economic activity by a lot. Now, the soft landing fantasy says that the Fed is done with the job of tackling inflation, and inflation is getting crushed and it's going to go down to 2%. Meanwhile, the pace of economic activity will recover if the Fed steps out of the way. And we have the soft landing. Inflation goes down to 2% and the pace of economic activity recovers. Now, today was the nail in the coffin for this fantasy because we're getting the news that the pace of economic activity is deteriorating at a rapid pace, yet inflation continues to stick. So let's go back to reality. Here's where we stand. Inflation at 7%, the pace of economic activities, let's say at around 2% or so. Now, the Fed is aiming for inflation to go down to 2%. So they need to do tightening. And tightening impacts both inflation and the pace of economic activities. Not in an equal way. Sometimes that varies. Sometimes we have lags, but the lags impact both. So when folks say, oh, the lags are going to impact inflation down, but somehow spare the pace of economic activity from going down, that is a fantasy. In reality, this is what the Fed is aiming for. This is what the Fed is seeing right now. They're not going to come out and tell you flat out, but this is what's going to happen, at least for now. The Fed tightens and they get the inflation rate all the way to 2%. But in doing so, they're going to push the pace of economic activity to be negative by a lot, and hence we get a recession. Now, here's the problem. Here's what makes me a little bit nervous. Here's what keeps me up at night. And here's what makes me feel that maybe I'm not bearish enough. A lot of you criticize this channel and say, hey, Maverick, you're too bearish. You're the king of bears. And I'm saying right now, maybe I'm not bearish enough. You know why? Let's go back to the Fed tightening. Inflation at 7%, the pace of economic activities, whatever number you want to throw out there, it remains positive all in all, yet it lags the growth rate in inflation. Now, we're getting a lot of data suggesting that inflation will be stickier than anybody anticipates. And pushing inflation down to 2% will be frustratingly slow on top of that. And this makes me really nervous. Look at this. Goldman Sachs came out today and said commodities will be the best performing asset class in 2023, handing investors returns of more than 40%. Now, if Goldman turns out to be correct in this call, what do you think will happen? The Fed will tighten the policy. The pace of economic activity will get crushed. It will go down to negative in contraction territory, but inflation will stick higher. Inflation might go from 7% to 5%, maybe 4.5%, and then stick and hold there, despite all of the bombs being thrown by the Fed. And we see the bombs thrown by the Fed impacting the economy negatively more than impacting inflation negatively, and hence we hit stagflation. Now, we are kind of in stagflation because there is a gap between inflation and the pace of economic activity, and we know who leads in this gap, but we will get into official stagflation if this happens. Now, let's entertain another scenario in which all of these pumpers and perma-bulls, the likes of the good professor from Wharton, for example, who say the Fed has to pause or even cut rates at this point. Back to the status quo. Inflation 7%, the pace of economic activity lagging, be it positive. If the Fed pauses, or better yet, cuts rates, guess what's going to happen? Inflation is going to spike significantly higher, perhaps all the way to 10%. And yes, we will see the pace of economic activity recovering and moving higher, but not at the same pace and the same speed and volatility in which inflation is going higher. Why is that? Remember, the damage is already done, and the recession will happen either way. Fed or no Fed. Look, for example, at the personal savings rate. Even if the Fed cuts the rate right now or pause interest rate hikes, the consumer is out of spending reserves. They're going to need a lot of time to build these spending reserves to stimulate the economy. In the meantime, the money already in the system, billions and billions of dollars, if not trillions, if the Fed eases, all of that money will flow into commodities, pushing the prices of these commodities higher because we still have supply problems. in these commodities. And some of these supply problems are stemming, for example, from the green energy lunacy, which is let's go all in green energy and abandon all of the sources of energy that we have right now. Well, that increases demand for resources that are already scarce. Number two, the shift to green energy reduces the supply of sources that we currently use, oil, gas, etc. So it is no wonder why, if the Fed eases by pausing or cutting rates, the money will flow into commodities right away, specifically oil and gas. And this will push inflation higher, yet the pace of economic activity is not going to recover the same way we see inflation recovering. And what's going to happen after that? The Fed will have to come back to tackle inflation down from a much difficult place. It used to be 7%, now 10%. And what's going to happen? They're going to have to be really aggressive and take inflation down from 10% to 2%. And in doing so, they're going to absolutely nuke the pace of economic activity into not a recession, but now a depression. The bottom line in this scenario analysis is all of these geniuses who are coming out on TV right now and in the papers and saying, oh, the Fed is over-tightening, the Fed has to stop. They're going to crush the economy. The alternative that you're advocating for will lead the economy into a depression. And you're only talking your book. You're only worried about your portfolio going down. And if you don't know what you're talking about when it comes to the economy, you better shut the up. Otherwise, you're going to lead the economy from what is supposed to be a recession into a depression with this kind of stupidity. And with that, folks, let's move on to the coverage of the stock market. And we begin with the closing of the indices today. And here we go. The Dow Industrial Average down big by 764.13 points, or a decline of 2.25%. The Nasdaq down big by 360.36 points, or a decline of 3.23%. The S&P also down by 99.57 points, or a decline of 2.49%. Now, when we look at the sector's performance today, all in the red, down across the board, and the laggards were led by communication services, technology, and materials. It was a shock to the market today, perhaps the delayed impact from the FOMC, and all sectors were impacted, nothing was spared, although energy came out on top, be it in the red. When it comes to the advance to decline ratios, the NYSE pathetic 13% advancing versus 86% declining. The Nasdaq 21% advancing versus 76% declining. When it comes to commodities, down across the board, the dollar shot up higher. Perhaps again the lag impact, a delayed impact from the FOMC. The dollar was up by about 1% for the day, and therefore the majority of commodities are down. When we talk about energy commodities, down across the board with exception of heating oil, which closed barely in the green, but the winner of the day is the party boy, natural gas futures with gains exceeding 6.75%. Now, natural gas has been surging as of late because we have a winter storm impacting at least 5 states, and unfortunately we have fatalities here. And the bad news is the winter season is still young. If we see more storms to come, natural gas prices will move higher. Now, when we look at softs, down across the board, and the losses were led by sugar and OJ futures, yet we have a rebound, finally, for coffee futures worth about 2.5%. And if you pull out the chart of coffee futures, you might notice the double bottom formation, so perhaps we have gains to come here. I know I called the bottom in coffee futures about a few weeks ago, and that was a bad call. I reversed right away, and coffee futures went down. But now I'm seeing more solid signs that perhaps this is the bottom for coffee. We'll see what happens. Now, when it comes to metals, the dollar is up, so it's not a surprise here that gold, silver, platinum, copper, palladium all down big. Look at the losses in palladium futures, down over 6.5% today alone. When it comes to meats, red again, and the losses were led by lean hogs, which lost about 2% worth of value today. When it comes to grains, mixed picture here. We have a positive closing led by wheat futures, and watch out for wheat here. We have more escalation in the war. And my hunch is we will see a retaliation by the Russians, which will end up blocking wheat supplies getting out of Ukraine. This will push wheat futures higher. It will push inflation higher again. But besides wheat, corn, and soybean oil, all closing in the green today, the rest closing in the red, and the losses led by soybean meal futures down about 1.25% for the day, but mind you, pulling back after massive gains. On to the big casino, the options market. What do we see here? The Three Musketeers, the usual suspects, are the top three spots. Number one, Tesla, with around 2.4 million contracts traded today. About 54% of the volume were for calls. And Apple at number two, with around 1.5 million contracts traded today. About 51.5% of those were calls. Amazon at number three, with around 1 million contracts traded today. About 64.5% of those were calls. The bottom line is we're seeing some bottom fishing here. We're seeing a lot of oversold readings in the RSI of many of these names, but specifically Apple, and therefore you have a lot of traders betting that we will see a rebound in Apple coming soon. But keep your eyes on the IV rank, the implied volatility, because if the implied volatility is moving higher, as the stock moves to the opposite direction, it has been moving on for a while now. In the case of Netflix, for example, it has been surging higher, and the implied volatility went down big. But today, the implied volatility moved significantly higher, and Netflix was down big, over 8.5% for the day, indicating that this kind of volatility will continue to increase. In other words, in the same direction of today. So perhaps Netflix right now is a good short. Any pops when it comes to oversold conditions will be faded right away. I'm looking at names such as Roblox, for example. Look at the IV rank at around 7.7%, and the name was down big today by almost 16%. In other words, if it rebounds higher in an oversold rally, I'll be looking to buy more puts here, expecting that the implied volatility is going to increase on the way down. Now keep in mind that names such as Ford, for example, has an implied volatility of around 6%. But keep in mind that Ford is not a high beta name. It doesn't move big one way or the other. So don't fall in the trap of, oh, the implied volatility is low for Ford. I'm going to load up and put options right here. Pick the name with the high beta but low IV rank, and they're breaking a trend and moving in the opposite direction. That is the message of the day. Moving on to the unusual activities that took place in the options market today, and we begin with the ticker HD, Home Depot. We have a massive bet here. Somebody bought the 290 puts for the expiration date, February 17th, with expectations that the name will go down and lose more than 11.5% of its value by the expiration date. They paid around $4.20 a piece to enter this trade, all in all spending around $8.5 million. And then what about the trade for the ticker AFRM, Affirm, a company that, by the way, could go down to zero. Bankruptcy. You say buy now, pay later, or buy now and pay never. Goodbye. I lost my job. I'm not going to pay you back. Anyhow, somebody sees this happening and they bought the 9.5 puts for the expiration date, January 27, with expectations that a firm could go down and lose more than 8% of its value by then. They paid around $1 a piece to enter this trade, all in all spending around $2 million. And then what about the trade for the ticker HON, Honeywell? Not a usual name that we see here, so somebody sees something here, perhaps hedging on a long position, and they bought the 195 puts for the expiration date, February 17th, with expectations that Honeywell could lose more than 6.5% of its value by then. They paid around $3.5 a piece to enter this trade, all in all spending around $3.5 million. And lastly, what about the ticker NUGT? This is the leverage bullish index for gold miners. It is 2 times, meaning if the GDX, the actual gold miner ETF, moves higher by 1%, this name will appreciate by 2% in that given day and then reset. Likewise, if the GDX is down by 1%, the NUGT will be down by 2% and then reset for the next day. So today, the GDX was down big. As the dollar pops higher, gold goes down, and the losses in the NUGT exceeded 8.5%. But somebody sees a rebound coming. And I do agree, but I disagree with the timing. Let the pop in the dollar play out, and then it's going to fade, and gold will find a footing and rebound higher again. But regardless, we have somebody who sees the opportunity right now, and they bought the 35 calls for the expiration date, January 20, with expectations that the NUGT will move higher and gain more than 6% by the expiration date. They paid around $2.30 a piece to enter this trade, all in all spending around $1.7 million. On to the heat map, a bloodbath across the map. Everything is red with few exceptions, but look at the big caps. Apple down over 4.5%. Google down over 4%. So is Meta. Microsoft down over 3%. Amazon down almost 3.5%. Industrials down big as we see the recession force creeping in. Metals down big. Even the good names, aka the recessionary names, yes, they outperformed, but they were in the red too. We're talking about the big pharma names, the food packaging names, utilities, real estate. They outperformed, be it in the red. Is that good enough? I'll leave that to you. But the notable decliners, let's talk about Apple, for example. We know the bad news from China but now from the regulations, specifically in Europe, because Apple was forced to end the racketeering revenue, the monopoly of the App Store, aka their rent, no rent anymore. This is the engine of growth of this company. You think the stock will do good if the engine of growth of the company is hammered? Of course not. And this kind of regulation is coming soon here in the United States. Another underperformer today was Netflix. NFLX was down big by almost 8.5% for the day. And the reason is, surprise, surprise, the ad-supported tier, which was a dumb idea to begin with and we called it out, well, it's not working anymore. From the get-go, it was a flop. You're issuing an ad-supported tier when the ad revenue is collapsing across the board. We have an ad revenue recession, and I have a front seat to all of that as a YouTuber. I know for a fact that my videos produce less revenue than they did a year ago, even though we have almost doubled the audience. So why is that happening? Companies are not advertising anymore. The crypto advertising boom, it's now a bust. We're not getting the crypto money anymore, and now all of a sudden Netflix wants to issue a ad-supported tier. Bad timing. And we all know the disaster of Ted Sarandos, who couldn't get to his head that this is a business. This is a streaming business, not a studio from Hollywood. Your job is to maximize the revenue and decrease expenses, not to go on a spending spree, cutting checks 100 million here, 200 million here, for the dumbest movies ever, just to get The Rock or whatever big celebrity you want to get. This is the work of Ted Sarandos. And if Hastings is listening right now, the ad-supported tier is a dumb idea. And a better idea would be pay per stream. If you have a big production that is going out, why get it out for free? You gotta pay per click. Small fee on top of your membership fee, and boom, problem solved. But of course, these Hollywood types, the likes of Ted Sarandos, all what they care about is rubbing shoulders with the big celebrities, the royals, for example, Prince Harry and her royal doucheness. I mean, how much more money can you milk bad mouthing your own family? It's gonna get old at some point. They better figure out a new gig. Otherwise, they're going to go bankrupt. But Netflix has no problem cutting a $100 million check to these boring dummies. Bad move, bad decisions, bad business plan. It doesn't matter how high Netflix stock is going to go. It is coming down. Without a better plan, without keeping expenses in check and improving margins, the stock will go down again. And today was just the beginning. And then we have Roblox. We talked about it in the options market a little bit, but today the name was down over 15% due to slowing growth. No surprise here. We're seeing the recession theme across the board. So Roblox is going down big time. I'm going to wait for a rebound and then short again. Yet when we look at the outperformers today, we see Verizon, and we talked about Verizon before. It is part of the recession theme, but we also have Tesla, which was an outperformer today. And the reason is, number one, we have Mama Cathie Wood, who's catching a falling knife once again, and she pumped about $12 million out of her poor investors' cash to buy the dip in Tesla. On top of that, we got the news last night that Elon Musk, surprise, surprise, has been dumping Tesla shares, billions and billions of dollars. And I warned Tesla culties, you gotta be careful. If you're too stubborn to book your profits and get out of the stock, at least use some hedging here. Buy some put options to protect yourself from the downside, because you got the head job against Elon with all of these funds dumping Tesla. That's number one. Number two, Twitter is a mess and he needs to raise cash, billions and billions and billions of dollars. And the only piggy bank he has left is TSLA, and he's gonna milk this piggy bank all the way until it's bone dry. So be careful here, standing on the way of two forces dumping the stock down. But boy, Elon is getting into more problems every single day. Last night, we talked about the rookie mistake by Elon Musk, the dumb decision of banning the account of Elon Jet, which is a 20-year-old kid who's been tracking Elon's private jet. Elon offered him $10,000 to take the account down. The kid counter-offered by $50,000. Elon got butthurt and he decided to spend $54 billion instead to buy the entirety of Twitter and ban this account, which hurts his credibility. And on top of that, today he wants to sue the kid, take him to court, and completely destroy his life. But the kid is not deterred and he says he's going to fight back, and the threats by Elon to sue him, there is not much ground for him to stand on, he says. This is public information after all, and therefore I say this was a rookie mistake, a dumb decision by Elon. You don't need to do this right now. Matter of fact, never. You promised to be a free speech absolutist. Are you or not? If you are, you don't ban accounts you disagree with. and you use safety and security as the reason behind that. It's a slippery slope. It's a rookie mistake. It shouldn't have happened at all because you got all of these forces, the deep staters and the likes, the media, they're all coming after you. And there is no time. You cannot afford to make rookie mistakes and hurt your credibility. Now, a lot of you told me today, hey, you're wrong about this, Maverick. Elon got it right. He should ban the kid. It's a safety issue, yada, yada, yada. Folks, the man is the richest man on the planet. He's a public figure. They're gonna track him either way. But banning this account is bad publicity. It hurts the credibility. And as he continues to uncover the Twitter files, and we learn more about the collusion between government and big tech, this is the wrong time to hurt your credibility. On top of that, you guys have to be a little more cautious of going all in, trusting Elon. I'm optimistic. I'm still supporting him. I'm still walking the walk with him to see if he's going to fulfill the free speech endeavor. But I'm being cautious, and the reason is this guy has a lot of ties with the deep state. We all recall when he said we're going to coup whoever we want. Deal with it. This is regarding the coup in Bolivia. He praised the FBI today. And remember, they also have him by the balls. I would say back a year or so before the whole Johnny Depp fiasco, back when I had around 6,000 subscribers, I said that this girl, Amber Heard, has done a lot of work for intelligence agencies, basically gathering compromising materials from folks, powerful folks, the likes of Elon Musk. He didn't just coincidentally run into Amber Heard and became her boyfriend. This was a project. This was a mission to target Elon and gather compromising material. And at some point, they're going to come to Elon and say, would you like this stuff to come out? Or are you going to behave? Maybe he doesn't care, but my hunch is he's going to choose to behave. So be careful here, trusting Elon 100%. Anyways, I guess I revealed a little too much here, so let's move on to the heat map for the ETFs. And what do we see here? Red across the board, the massacre, bloodbath. But the outperformers, number one, the XOP, energy, managed to close in the green. Yes, the XLP, the XLU, the XLV are down, but they're outperforming the cyclicals, the inflationary/expansionary ETFs, technology, for example, the XLK down big, SMH for chips down big, the XRT for retail down big. So again, outperforming, but be it in the downside too. When it comes to the ETFs for the VIX, look at this. We have a recovery now. The lag effect, it took a day before we saw what happened in the FOMC translating in the VIX, in the dollar, and in the stock market as a whole. Now, when we talk about the international ETFs, notice that the Chinese ETFs, the FXI, MCHI, are down, even though we got more good news out of China. And it started with the reopening, and then perhaps the optimism that the pace of economic activity in China is picking up. And now we have, hey, the delisting for these Chinese companies in the U.S. market. It's not going to happen. Despite this good news, Chinese ETFs and Chinese equities, at least here in the U.S., names like BABA and JD went down. In other words, we have exhaustion of good news here. It appears that the market milked all of these good news and ran it as much as it can. And it's a bad sign when we have a good piece of fundamental news, yet the underlying stock reacts negatively. It indicates that perhaps the forces of gravity will pull it back. Moving on to charts, and we begin with SPY, the S&P 500 30 minutes chart. We talked about the bear flag playing out and perhaps more pain to come, although the chart stopped at the support of 398. Well, today we're seeing the continuation of the pain, perhaps the real reaction of the FOMC with a massive gap down right off the gate. And the chart lost the support of 393, 391, although it attempted to climb above 391 by the end of the day, and so far could not make it. Now, can it give it a shot again tomorrow? Perhaps because we have oversold conditions on the RSI. But that last pop by the end of the day kind of fixed the oversold conditions on the RSI. In other words, we could see another leg down tomorrow, and perhaps the chart becomes really oversold at the support of 385.15. And then we get an oversold bounce. With that being said, with a massive decline today, if you've been holding weekly put options, today was the day to book your profits, even if we have declines tomorrow. Because the risk versus reward says book your profits since you have weekly expirations, because for all you know, the oversold conditions on the RSI right now could play out tomorrow. And we could see short covering right away. It's options expiration after all, and we could see the chart moving higher above 391. So why not book the profits right away, today, before you head into options expiration? But my hunch says we have more declines to come here. At least if you're a bull, if you're betting for a rebound rally, you should be be wishing that we're going to see another ugly day tomorrow that takes us all the way down to 385, and then we see severe oversold conditions, and this will merit an oversold rebound rally. Now, here's the daily chart for the continuous contract for the S&P 500. Major development today because the support of 3,960 was violated. We have a closing below this number, and now the support becomes 3,855. We look at the RSI, it is accelerating to the downside. We look at the MACD indicator, it is firming up to the downside, indicating more bearish momentum to come. In other words, it is just a matter of time, despite the rebounds and the bounces, before the chart cracks below 3,855 as support. And again, despite the little ticks higher and lower, this was all in all a head and shoulder formation, and it is playing out right now. We'll look at the SPX, the weekly chart for the cash index, major reversal candle. I know we have 1 day left, but it got to the line again and it reversed. And if it closes at the lows of the week, we have a major confirmation. The SPX will make a lower low, and that low would be at around 3,270, and you don't want to miss that downside playing it via put options or shorting straight out. How about the Qs? 30 minutes chart for the NASDAQ. We got a similar story to the SPY here. A major gap down, and the chart lost 284 support. It lost 280 as support, which is or supposed to be home base. Now, in typical charting behavior, when the chart loses an important level of support, despite the rebounds from an oversold rally, looking at the RSI, for example, it's not going to make it above 280. Any pop, any rebound is an opportunity to short because the major support line was broken today. And the next destination for support would be all the way down to 269.29. Here's the daily chart for the continuous contract for the NASDAQ. Again, major development because the chart lost an important support of 11,689. And now the chart is eyeing the June bottom at around 11,058.5. The RSI is in negative divergence, so is the MACD, and it is accelerating to the downside, indicating more bearish momentum to come. And all in all, this was a head and shoulder formation, and now it's playing out. We will look at the IWM, the Russell 2000, small caps. This is a 30 minutes chart. It lost the important support, which used to be a gap support, now resistance, and it is eyeing 174.22 as support. Now it is a little oversold on the RSI, but it has plenty more room to go. So any pop right now, let's say it goes all the way in a retest of the gap support, now resistance, it would be a major rally, and I'd be a little careful shorting if that happens. But let's say we get a pop, a rebound, it get us all the way to 176, 177, and then we start to see the chart weakening, stalling, consolidating, and moving slightly down. That would be a permission to double down on the shorts and take it all the way down to 174.22, if not beyond that. And here's the daily chart for the dollar index, the Dixie. Today we got the lagging reaction that we're supposed to get yesterday in the aftermath of the FOMC. So the Dixie was playing possum all along, moving down, showing weakness, but today we got the real reaction. We talked about the RSI, the MACD indicators, pointing out for an upcoming bounce. And folks, this is where confidence makes a major difference. You look at the indicators, the RSI, the MACD, you know there's a pop happening, and you know that the catalyst should be the FOMC. But instead, we get the opposite reaction, where the dollar goes down. It doesn't make sense at all. But if you are confident in your analysis, you know it's going to happen sooner or later. And perhaps we got an knee-jerk reaction in the aftermath of the FOMC that distorted things, perhaps related to options expiration. Who knows? But the indicators were pointing out for an upcoming rally. So if you had the conviction and the confidence, you knew ahead of time that the dollar is due for a pop. And indeed, we got the pop today, and that ended up rattling the equities market big time. And of course, the telltale was gold. Gold refused to rally yesterday, even though the dollar was down. As if gold was saying, watch out, the dollar is playing possum. And indeed, it was playing possum. Today, it popped higher, and gold went down. And now we're seeing the bear flag pattern playing out, and sooner or later, this continues to play out, and my hunch is it will continue to play out. We will see gold losing 1,763 as support, meaning there are more gains to come for the dollar here before it reverses again. So if you've been eyeing buying gold and you've been waiting for a pullback, here's your pullback. But wait for it. Give it a little time until we see signs that the dollar is moving down again and gold is rebounding from a reliable support. Then you have the permission to buy gold because the weekly and the monthly charts are suggesting gold higher, the dollar down. And here's the weekly chart for UK oil, Brent, again in negative divergence for the RSI, for the MACD, but so far so good. We have a rebound off 77 as support. Now can or will UK oil close above 85 by the end of the week, meaning tomorrow? Because if that is the case, that would be a major victory for oil bulls. But if it doesn't, It's not a big deal so long as it doesn't close below 77 as support. We're seeing some improvement in the RSI in the weekly chart, but not a lot of improvement in the MACD indicator. In other words, we're not seeing a confirmation that this is a bottom for UK oil right now. If we do have a crossing in the MACD indicator from a weekly perspective, then we got a confirmation that this is a bottom and perhaps oil will stage yet another rally. Not to make all-time highs, not to surpass the previous highs, but just to initiate a new rally. This could be good enough to rattle the stock market because the talk will become at that point, hey, inflation is moving higher, but we're seeing weakening in the economy. And oh, by the way, the Fed is not done tightening. Now, here's the daily chart for the 10-year yield. Unlike the dollar, we're not seeing a lagging reaction here in which the 10-year is popping higher. But I have a gut feeling that we will see a pop higher in the 10-year. For one thing, look at the MACD indicator, look at the RSI. They're all oversold right now, and they're moving their way to become positive again. In other words, we have another pop coming in the 10-year. And the weekly closing becomes really important. Will the 10-year close above 3.5% by the end of the week? And that would be an indicator that we have more gains to come in this chart. Don't count it dead yet. Even though we know that maybe the 10-year is moving down in anticipation of the recession. Yes, the Fed is raising rates higher. Of course, the morons on CNBC and the likes are saying, oh, the bond market is laughing at the face of the Fed. The bond market is calling bluff. No. The bond market is not calling bluff. All what the bond market is saying right now, if the Fed continues to increase rates higher, then we see the inevitable destination of a recession, and therefore the 10-year is moving down. But it hasn't made up its mind yet. My feeling is we have yet another pop in the 10-year before it goes down for good in anticipation of a recession. And here's another evidence that we will see a pop coming in the 10-year. Look at the TLT, a daily chart. It continues to bounce against the resistance of 109.5, and it couldn't make it. And now we have overbought conditions in the RSI, the MACD. We see negative divergence in the RSI from the daily chart perspective of the TLT, meaning we have a pullback coming in the TLT and a pop coming in the 10-year yield. Now, the dip will be bought in the TLT and the rip will be faded in the 10-year yield, and that would be the playbook for now, which is, by the way, the playbook for the recession. Now, moving on to the VIX 4-hour chart, what do we see here? We're seeing the lag reaction from the FOMC. The VIX is moving higher, but not convincingly so. It should have popped significantly higher. It should have closed above 24.29. So there is a mystery here, and my hunch is it is related to options expiration. We have pre-positioning that prevents the VIX from moving higher, but my hunch is we will see the real reaction of the VIX next week after options expirations out of the way. And here's another way to look at the chart. If we clean it up and we use a line chart, isn't this a reverse head and shoulder formation in the VIX? Meaning sooner or later we'll see the VIX popping significantly higher. Now what about Apple? 30 minutes chart. What's going on here? Massive flush down. It lost 138.79 as support, which I thought it might hold on to this number for a little while. But Apple is a lot weaker today, relatively speaking, of course. But we have oversold conditions on the RSI and the MACD. In other words, we could see an oversold rebound here in AAPL, but this rebound will be faded. We will see it moving down once again to the next support of 134.37. What about Tesla? 30 minutes chart. What's going on here? We talked about the head and shoulder formation that played out, and then we talked about, depending how you look at it, but it could be a reverse ABC pattern. So far, we got the B leg and some of the C leg. A lot of you said, hey, should we buy Tesla calls right now? Be careful. Wait till the next support. That's my take at least. Do whatever you want to do. But the reason why I'm being really careful here, if we zoom in to a 15 minutes chart, look at this. Isn't this pattern all in all a bear flag pattern? And down we go to the support of, I believe, 130.77. That is my take for now. And lastly, what about Bitcoin, the daily chart? What's going on here? It stalled at the resistance of 18,000. We have a reversal candle followed by not a full confirmation. It would have been a full confirmation had we seen a close below, not the previous candle, but the one before that. That number, I believe, is at around 17,000. But the key word here is yet. We don't have a closing below 17,000 yet. But that could happen as soon as tomorrow. And then we have a confirmation, and down we go all the way back to 15,000. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? Not much. We have the flash PMIs, aka the manufacturing and services PMIs. But besides that, this is all I got for you for now, folks. Thank you for listening, thank you for watching, and I will talk to you again over the weekend. Take care.